one. This is Scott Becker with the Becker Business Minute, the Becker Private Equity Business Podcast. This is a market update, 10 quick updates. Thank you for listening. First, yesterday, March 9th, the markets were hammered based on really challenges facing banks and the banking system. We'll talk about that more. Also based on continued concern about where the Fed is going with rates. There's an article in the Wall Street Journal. Banks lose billion in value after tech lender Silicon Valley Bank, SVB, stumbles. Second, the bank crisis that's going on currently is really driven by a few different things, but it's bleeding into other banks. Silvergate Capital, a bank focused on crypto, has failed and is voluntarily winding down. Then Silicon Valley Bank, a big also tech and crypto lender, dropped 60-70% yesterday, 67% today, and it's dropping heavily based on really a run on the bank as venture capital sponsored companies are being advised to take their money out of the bank. SVB had been sort of a fixture of Silicon Valley as a lender to crypto, venture capitalists, and a host of others. They had reported a loss of $1.8 billion, which for a small bank is a big, big loss. That sort of led to a run on that bank. The banking issues with Silicon Valley Bank and these crypto banks are then bleeding into the major banks. JP Morgan, B of A, each lost 5-6% yesterday. Goldman Sachs down another 7-8% as well. So that's what you're seeing so far. Third, the major indexes are now up a little bit this morning. There was a jobs report that reported a high level of jobs, but that were added, but unemployment numbers went up to 3.6%. That was sort of unexpected. And that's really based on more people who have flown through pandemic savings going back to work. So more people entering the workforce again. So even though a lot of jobs were created, unemployment percentages went up, which was not expected. Fourth, yesterday, the Standard & Poor's, the S&P 500 lost 1.85%. The NASDAQ lost 2.05%. Fifth, the Fed and the markets are really reacting to the jobs report, the bank issues, and other things. And this is leading people to increasingly believe that the Fed is going to move towards 25 basis points, not 50 points, 50 basis March 21st, 22nd, their next meetings when they raise the Fed funds rate. Just a lot going on, a lot of macro challenges between banking, employment, unclear, still robust, but unclear as the unemployment rate ticks up a little bit. Sixth, Bitcoin dropped another 8% yesterday. See an article on Yahoo. Bitcoin tumbles a 7-week low as bank liquidation, regulatory pressures weigh on crypto, something all of us are watching. Seventh, the 10-year Treasury yield dropped to 3.7% or so today. When longer-term Treasuries are so much lower than short-term Treasuries, this generally means that people are projecting in the long run the Fed is going to have to reduce rates, not keep on raising rates. So what you have right now is the 1-year Treasury is about 5%, the 10 years about 3.7%. That's a huge spread, at least traditionally. And that generally projects that over the long run, the Fed won't be able to keep rates as high as they are now. Eighth, as we sort of indicated earlier, new jobless claims rose a little more than expected. Last week, we reported this yesterday. Unemployment and new jobs created in the month of February are higher than anticipated, but more people re-entered the workforce, probably signaling that some people have blown through pandemic savings and ready to get back to work. This has led, for the moment, to a situation where unemployment has ticked up to 3.6%. That was unexpected. Ninth, it's unclear whether new cracks in the economy will lead the Fed to raise rates 25 basis points instead of 50 basis points at their Fed meeting, their March meeting. This is what a lot of people are banking on now. 10th, we talk about this often. Allocation is everything. In times of turmoil in the market, it's a critical time to sort of understand the real world behavioral testing of yourself as to how much you could live with ups and downs in the markets. I know myself, I'm a nervous investor, I have a nervous stomach, so I'm far better off having a very conservative portfolio. So when the market tanks, I don't, lose sleep. I lose sleep anyways because it's how I'm wired. But it's really important to really understand how you react to allocation, not just when the stocks and the markets are going up. That's easy. There are lessons we learn there too, but also how you feel when the markets go down and whether you could live with the allocation you have. The flip side is when the markets are tanking or going up, it's not the time to necessarily adjust your allocation or to make rash moves, but it is a good time to think about how do you react to these things. Again, these are 10 stories we're following this morning. Thank you to listening to the Becker Business Minute and the Becker Private Equity and Business Podcast.